Good afternoon and welcome to the FX Week Ahead live market analysis with myself, Giles Coughlin. Just taking a look at the market this week, we have seen some very unusual and large moves in the equity markets. This has been on the coronavirus fears, so we're going to be covering that during the session. Just as folks come in, just want to have an opportunity to say hello and welcome to the webinar. Good to have you on board. The quick explanation on this slide is that just to make clear that any different trade setups, stop losses, take profits, instruments that we're looking at, we're not using this as a signal service. So the idea isn't that you trade based on the information in this webinar. The idea of this webinar is to get experience and understanding about how the currency, the commodity, the equity markets move, so that you can make your own investment decisions. Just to make that clear as we get started. This week we have seen large moves, and it has been on the spread of the coronavirus. If we just take a look at the latest spread, we can see that over 80,000 cases come from mainland China. That's still the main area from which the coronavirus is spreading. We've got a total confirmed cases of 89,000 with around 3,000 deaths. And looking further afield, we have some larger moves now. South Korea, we're seeing some very big moves. Italy and Iran, these are some of the biggest outbreaks that we have in the country at the moment, and 86 in the US. So looking at the map as a whole, this is a very different story from only just 1 week ago. We are really seeing some very large moves now in the spread of the coronavirus. And it's been this spread of the coronavirus that we've been seeing which has really concerned the equity markets. So last week, we saw huge falls in the equity markets. Let's just take a little look at the, let's just have a look, hang on, that's it, let's look at this one. Here we go, let's look at TradingView. And we'll take a look at the, the Dow. So looking at world indices, let's look at the Dow. And you can just see this enormous fall in the Dow Jones. So this is a daily chart, and you can see the extent, the heaviness of those falls have been extreme. Even and taking it out to the weekly chart, you can just see that's just one very heavy fall. And you can see it's hard to see a day comparable to that day, to that week rather, that we've had. You've got to go back a number of years, even 2008, 2009 crisis to see comparable days. That does give an indication of how heavy those losses have been. And this has all been on the coronavirus outbreak fear. And the picture is this, is that if the virus spreads around the world, then countries, companies, they're going to be able to do less business, profits, targets and earnings are all going to be missed because companies aren't able to keep up their production. And as a result, we've been seeing the equity markets fall. Now, on Friday, there was a slight pickup. The last day of the week, there was a slight pickup in the S&P 500. I'll just show you that. And the slight pickup into the close is here, you see, just trying to pull off those low levels. And the reason for that pickup in the S&P 500 was that the US Fed Powell started indicating, giving hints that he might be easing rates to support the US economy. That's why we saw a pickup in the equity markets there. So today, we've seen a similar fall in equity markets. We've had 2% losses at the moment in the Euro Stoxx, CAC 40, Spanish IBEX, and the Italian FTSE is now down over 3%, approaching 4%. And that's obviously because of Italy's exposure to the coronavirus. You can see Italy's high up there alongside South Korea, so we're seeing particular falls in the Italian index. So looking, the key geopolitical event for this week is going to be the coronavirus. That is going to be the focus of the week. So everything else that's happening, we have to view it through that lens. And the expectations have now really grown for central bank action in order to support different countries' economies. The dollar index has fallen, and I'll show you the fall in the dollar index. And this has been falling heavily on the expectations that the Federal Reserve is going to have to cut interest rates. So that's why we saw the Dixie falling out of the open from this morning, and it's still falling now just off at most recent lows at 97.50. And that's because the Federal Reserve is expected to cut interest rates. And if you look, we'll look at the futures markets in a moment, but other central banks around the world are expected to follow suit. And there is currently a pause on easing hopes. That boosted stocks early in the morning. So when I wrote that, that was early in the morning. But as I said, we're at a crossroads. So if we take a snapshot of the equities now, we can see, just looking here across the Bloomberg terminal, you see we have heavy losses across the European stocks. The Shanghai Composite was boosted overnight, so there's a little bit of optimism. Nikkei was up nearly 1%. That optimism has now faded, and the market is looking, you know, the central banks will have to act quite quickly to address these heavy falls in the stock markets. So we're on a firm risk-off mood, and we're in the risk-off mood. We see yen strength, Swiss franc strength, and we see Australian dollar, New Zealand dollar, Canadian dollar weakness. So that's where we are at the start of the week, and this is now seen as a 100% chance of a 50 basis point rate cut. So there's huge expectations of a rate cut now, 100% chance of a 50 basis point rate for 18th of March. So there has been a fundamental shift in what the markets are expecting. It's all based around those coronavirus fears. So everything that we're looking at for this coming week, we need to look at the coronavirus fears. We need to get a good understanding and a good handle on how much the coronavirus is spreading, what's going on, and that will give us the indication that we need to really, really understand the rest of the currency market moves. So that we can't look at the markets aside from the coronavirus fears. So we really, really want to keep focused on that. And that Fed expectations of a rate cut is what's weakening the US dollar at the moment. So we're seeing dollar weakness at present, but we've got to keep our eyes open for any shifts in mood, any shift in sentiment to watch that mood doesn't change. But it'll all be on the coronavirus, whether the coronavirus is spreading, getting worse, or getting better. So with that said, we'll now move into the week ahead to look what we have coming up. Now, we have had the private Caixin manufacturing PMI, which is the small to medium private industries in China, and we've seen a heavy fall in the manufacturing PMI. We can see how heavy that fall is. These are unprecedented heavy levels. And the official PMI data, the non-Caixin PMI data, was also out on the weekend, and that was very, very low as well. Just go back to tagged it on to the end of this week. You can see the manufacturing PMI this is the more official larger companies. You can see these are huge. Like, that's probably the lowest you know, the lowest ever recorded figure. You can see how incredibly low that is, which really tells you, you know, everything you need to know about the slowdown that's coming out of China because of the coronavirus. You can see why the equity markets have been falling so heavily now. This morning we had some more upbeat European manufacturing data, so we can see that the coronavirus slowdown hasn't yet come into this data. You know, better than expected for Italy, just above better than expected for France, Germany's final manufacturing PMI. So seeing some recovery in the PMIs is supportive for the euro in the very, very short term, but longer term is the coronavirus fear, which is going to get rid of all of that positivity. And as soon as we get some kind of quarantining happening in Europe, we're going to see these figures rapidly fall down as people can't get to work, people aren't able to go to the factories, production levels are not met. So we'll get an expected fall in this. We've got ISM manufacturing PMI coming out of the US later. Coronavirus is not likely to expect that, but any strong number here, expect that to be faded on the expectations of a Fed rate cut. We've got the Australian building approvals month on month and the cash rate statement. Now you can see that the expectations are now for the RBA to cut interest rates. And those expectations are for a 25 basis point rate cut at this meeting. That's going to be on the coronavirus fears. Remember, Australia's economy is very tightly linked to China's economy. So what you need to look for here is a surprise. So if they don't cut interest rates, expect an immediate buyers in the Australian dollar. If they cut by more than 0.5%, then expect heavier sellers. So keep an eye out for central bank statements this week. We've got a couple coming up, and the particular issue is that with the coronavirus fears going on, we could get unexpected action from central banks. So that's something to keep a very keen eye on this week. And again, look at the forward guidance for the rate statement. We've got Bank of England's Governor Carney speaking. Nothing expected there, although obviously the coronavirus is expanding in the UK. We've now got over 36 cases, 35, 36 cases in the UK, and that number is growing all the time. Got Australian dollar GDP data. Again, that is likely to be lower than the recent figures because we've seen some pretty poor data out of Australia recently. If you go back to last week, oops, wrong one. If you go back to last week, and if you look at the Australian data, we had a bad miss on the private capital expenditure. Construction work down was a bad miss. So two of those data points, both of those data points go into Australia's GDP. So building approvals will be another final important data point. But either way, you're expecting a drag on Australia's GDP on Wednesday, March the 4th. So obviously, if that doesn't happen, or if there's a beat, that will be against expectations. So you'd expect buyers to come in, but you expect those buyers to be faded on the coronavirus fears. We have a rate statement for the Bank of Canada. Now, this is an interesting one. Bank of Canada expected to keep their interest rates at 1.75%. However, there's a number of banks who are seeing the Bank of Canada easing policy this week. So Barclays, ING, Rabobank, and Scotiabank all see the Bank of Canada cutting interest rates at this rate meeting as a surprise cut. So obviously a surprise cut can be a great opportunity for sellers. So just keep your eye open on that rate statement around that time. If there is a surprise rate cut, expect Canadian dollar weakness and US dollar, Canadian dollar, we expect the US dollar, Canadian dollar upside on a surprise rate cut. So that's the pair to really keep an eye on should we get an overnight rate surprise cut. So keep your eye out for that. Again, the services PMI data, we're not expecting that to be hit by the coronavirus yet, so that should hold up. And potentially any bids in the US dollar on the back of that will be faded as long as the expectations for a Fed rate cut remain. The other thing to watch out for the US dollar is that sometimes the US dollar operates as a safe haven currency alongside the yen and the Swiss franc. At the moment it isn't. We're seeing the US dollar being sold on federal rate cuts which are expected. But just watch out that the US dollar doesn't suddenly switch to a safe haven currency, which it does operate at. And obviously with heightened risk at the moment, just keep an eye on that. On Thursday, a very important meeting for OPEC. Oil prices have been really falling recently, and the fall in the oil prices, we'll just take a look. You can see that the oil prices have been falling for 6 days in a row. You just go to the hourly chart, you can see 1, 2, 3, 4, 5, 6, these 6 days, seeing these heavy falls. And oil's trying to find a little bit of base at the moment. And the reason that oil's trying to find a base is that you can see that the heavy support here around the 43 handle is that OPEC will be meeting on Thursday, and the rumors are that Saudi Arabia is proposing a 1 million barrel per day rate cut. So that's more than the 600,000 barrels per day rate cuts that have been mooted earlier in February. So what we're going to look at here now is, what do OPEC actually do? If OPEC suggests a 1 million barrel cut and Russia agree to that cut, that's the crucial country at the moment is Russia, then we'd expect some bids in oil, but we then expect oil to be sold off because the demand picture is very weak for oil at the moment. China's expected to have a massive reduction in their oil output and their oil consumption, and so this is why we've seen, look, these heavy oil losses from like the 23rd of January, when the coronavirus fears really started building. That's when we kept seeing these oil sellers coming in, and oil sellers are still here. So Thursday's meeting will be key for this next path of oil. If there's no arrangement, if Russia don't act, if there's no production cuts, then we expect more downside into oil. Obviously, this sort of 42.50 handle is a key support. So we're heading into key support here. So obviously we wouldn't favor selling into those lows. Ideally, looking for a retracement back up to this 50-50 level, we would expect to find sellers and stops above recent highs. So that's just something to be very, very aware of on oil. It'll all hinge around OPEC as OPEC meets on Thursday. So be aware of that. A couple of central bank speakers on Thursday. Again, that could be potentially, going back to the Bank of Canada rate meeting on Wednesday. Now, if the Bank of Canada, if they keep rates on hold, then the important part will be what's the forward guidance. So what's the Bank of Canada indicating? And if the Bank of Canada start indicating rate cuts are coming, then we can start expecting Canadian dollar weakness out of this event. And obviously, Governor Pollock speaking the day after will be important in light of whatever's said on Thursday. So keep an eye out on that. Finally, on Friday, we've got Canadian data and US employment data out. Again, with the US employment data, US employment has generally been pretty strong. Just take a look at the graph. See, it's been pretty firm. If you go back some years, you can see going back more years through the financial crisis, the employment levels are very low, and they obviously moved higher. We're currently pretty firm, pretty well supported employment, so not expected any difference this week either. We've got a forecast of 185. So taking that week together, the key theme for this week is coronavirus. It's making sure you're aware of whether coronavirus is getting worse or getting better, and not getting caught out by some strong volatility moves. In these kind of market environments, we do get strong and very volatile moves. So just to be prepared for those and to be ready for those, and don't get caught out if and when they occur, and make sure that you're keeping your ear on the risk tone. So with the risk tone firmly off at the moment, we're expecting the commodity currencies to be sold and the safe haven currencies to be bought. Just take a quick look at the currency sphere right now. I'm just going to call up on my terminal. Just 1 minute. I'm just going on to Reuters icon, and I'm going to look at the currency space. There we go. So look at the currency space. We're seeing some strength into the Swiss franc, mixed picture with the yen, and we're seeing some broad commodity currency weakness in New Zealand dollar, Canadian dollar, and a little bit in the Australian dollar. So yeah, in these extreme market conditions, sometimes the normal playbook doesn't work. So one particular commodity that is really puzzling at the moment is gold. Just taking a look at the gold chart, this is just worth mentioning. Gold has been selling off last week when normally you'd expect gold to be bid heavily, but instead gold was sold off heavily. So it could have been sort of profit takers up at these high levels. So just to be aware, keep watching gold. I am still expecting buyers on gold. So any return down to this level here, the 1550 and below, down to 1530, 1550 down to 1500, still expecting buyers from here to here. But just be careful that if price does keep moving down here and starts accelerating down this road, these lows, something else is afoot, something else has gone wrong. So keep an eye on gold. We should have gold supported now with the Federal Reserve looking at cutting interest rates by 50 basis points. So that should support gold in the near term. So like a near-term place for gold buyers would be buying at market and just placing stops here underneath the 100 exponential moving average at sort of 1525. Okay, that would be a place to make sense, and then looking at profit taking up at the 1660 handle. Okay, so that's the kind of place where you'd expect, and I also am currently expecting a run up higher up towards 1700. So that's just something to be aware of. But with gold, the reason I'm hesitating is with gold selling off when I was expecting it to be buying last week, it's just left me scratching my head. Some analysts are saying that there was some heavy profit taking in gold, that people who were lost money in equity markets were offsetting those losses against their gold positions. So that could have been what was happening at the end of last week, but I'll leave it to you to judge. Don't forget, next week, on Wednesday, 1 o'clock GMT, we'll look at an online trading workshop, and we'll look at how to take some of these principles and use them day to day. I hope you have a very good week, and I look forward to seeing some of you on Wednesday, the online trading workshop. Just be careful out there this week, and expect some wide ranges in markets. So expect big moves. So just make sure you're not using too much leverage in these kind of markets, because there's a potential for larger gains and larger losses. Okay, guys, take care, and I hope to speak to you soon. Goodbye.